The financial markets were rocked this week as shares in the e-commerce and technology behemoth, Amazon, took a dramatic tumble, plummeting by more than 9% in a single trading day. This precipitous decline was not a random market fluctuation, but a direct and forceful response from investors to the company's latest financial disclosures and its ambitious, high-stakes vision for the future. The sudden sell-off illustrated just how sensitive Wall Street has become to the strategic decisions of its largest players, with many investors clearly signaling their deep unease about the company's new direction by rushing to divest their holdings. The event sent a clear and powerful shockwave across the trading floors. The primary catalyst for this alarming stock crash was a profound sense of anxiety among investors regarding Amazon's proposed spending strategy. Wall Street, a world notoriously focused on quarterly earnings and immediate returns, grew deeply concerned that the company was preparing to embark on an unprecedented spending spree that could severely impact its profitability and cash flow in the short to medium term. This market reaction brought to the forefront the age-old tension between making bold investments for long-term technological dominance and the pressing need to maintain short-term financial discipline and shareholder value. The market's overwhelmingly negative verdict served as an unambiguous warning to Amazon's leadership. This major market event caused a significant tremor on Wall Street, a natural consequence given Amazon's status as one of the world's largest and most systemically important corporations. A substantial drop in its stock price inevitably creates a ripple effect capable of dragging down entire market indices and souring investor sentiment far beyond a single company. The news left many market participants feeling jittery, not just about the future of Amazon, but about the overall health and valuation of the technology sector as a whole. It was a stark and sobering reminder of how swiftly market confidence can evaporate based on the strategic maneuvers of one corporate titan. The fallout from Amazon's announcement extended beyond its own shareholders, creating a broader climate of caution. Analysts and traders immediately began to re-evaluate their positions on other major technology firms, questioning whether similar spending patterns were emerging elsewhere. The incident highlighted the immense pressure on corporate executives to balance innovation with fiscal prudence, especially when dealing with a technology as hyped and capital-intensive as artificial intelligence. The market was left to grapple with a fundamental question: was this a sign of a healthy, forward-looking investment cycle, or the beginning of a reckless, speculative frenzy that could end badly for everyone involved? At the heart of the market's anxiety was Amazon's stunning announcement of an extraordinarily ambitious investment plan, earmarking a staggering $200 billion for advancements in artificial intelligence and robotics. This colossal capital expenditure is slated to be deployed by the year 2026, a clear signal of the company's intent to not just participate in the AI revolution, but to dominate it entirely. The strategic objective is to cement Amazon's position as the undisputed global leader in these transformative technologies, which are widely expected to redefine the competitive landscape across nearly every industry imaginable. This monumental plan underscores Amazon's unwavering commitment to securing its future, even at great immediate cost. This massive investment is not merely about funding abstract research or developing new software algorithms in a lab. It represents a comprehensive, top-to-bottom overhaul of Amazon's core operations, integrating sophisticated robotics and AI more deeply than ever before. From automating its sprawling network of fulfillment centers to deploying autonomous delivery drones and vehicles, Amazon aims to leverage this technology to achieve unprecedented levels of efficiency, drive down operational costs, and pioneer entirely new products and services for its customers. This bold strategic pivot is meticulously designed to ensure the company's market supremacy for decades to come, justifying the sacrifice of short-term profits for what it sees as essential long-term gains. However, it was the sheer, breathtaking scale of the $200 billion figure that sent shockwaves through the investor community and triggered the massive sell-off. Shareholders and market analysts alike began to intensely question whether any company, even one as large and profitable as Amazon, could successfully manage such a gargantuan expenditure without critically impairing its financial stability. The prevailing concerns centered on what was perceived as excessive spending and a concerning lack of cash flow discipline, which became the primary justification for the flight of capital from the stock. The market is now watching with bated breath, waiting to see if this historic gamble on AI and robotics will ultimately pay off or devolve into a cautionary tale of corporate overreach. The announcement forces a re-evaluation of how investors view corporate growth in the age of AI. For years, Amazon was lauded for its day one philosophy, which prioritized relentless innovation and customer obsession over immediate profits. This latest move, however, appears to have tested the limits of that philosophy for many. The market's sharp rebuke suggests a growing demand for a clearer and more immediate return on investment, even for revolutionary technologies. Amazon's leadership now faces the immense challenge of reassuring its shareholders that this $200 billion path is not just a speculative bet, but a well-calculated and necessary step towards a more profitable and dominant future. The dramatic decline in Amazon's stock value was not an isolated incident, but rather the most visible symptom of a much broader trend currently gripping the entire technology sector. Across the industry, many of the United States' most prominent tech firms have unveiled similarly colossal spending plans focused on building out their AI capabilities, with collective capital expenditures projected to exceed an eye-watering $650 billion. This unprecedented wave of investment, while demonstrating the industry's conviction in AI's potential, has simultaneously instilled a deep sense of nervousness among financial experts and investors. The core concern is that these companies are collectively spending too much, too fast, on a technology whose commercial viability is still largely unproven. This pervasive spending has triggered a wider sell-off in tech stocks that extends far beyond just Amazon. Companies with significant exposure to the AI ecosystem, whether as hardware suppliers, software developers, or infrastructure providers, have seen their stock prices retreat as investors adopt a more cautious and risk-averse posture. The collective anxiety sweeping through the market reflects a growing fear that the industry has become swept up in a wave of irrational exuberance, overestimating the immediate impact of AI. This has cast a pall of uncertainty over many technology companies, from established giants to nimble startups, all of whom are now feeling the pressure of heightened market scrutiny. The current market climate has placed immense pressure on the leadership of all major tech firms to rigorously justify their enormous AI investments to a skeptical shareholder base. It is no longer enough to simply talk about the transformative potential of artificial intelligence. Companies are now expected to present a clear, credible, and tangible path to profitability. They must demonstrate that their spending is the result of careful strategic planning, and not merely a knee-jerk reaction to industry hype or the fear of being left behind. The entire sector is now under a microscope as the market desperately tries to distinguish the future long-term winners from those who are simply overspending in a speculative frenzy. This period of reckoning is forcing a difficult conversation within Silicon Valley and on Wall Street about the true value and timeline of the AI revolution. While few doubt the technology's long-term significance, the immediate question is one of pace and capital discipline. Investors are increasingly wary of funding what could amount to a very expensive multi-year research and development project with no guaranteed payoff. Consequently, the ability of a tech company to articulate a coherent and financially sound AI strategy has become more critical than ever in maintaining market confidence and stabilizing its stock price in a turbulent and uncertain environment. The frenetic pace and monumental scale of spending on artificial intelligence have resurrected a ghost from Wall Street's past, the growing fear of an AI bubble. An increasing number of market analysts and veteran investors are drawing unsettling parallels to the dot-com crash of the late 1990s and early 2000s. During that infamous period, investors, caught in a whirlwind of hype about the new digital frontier, poured trillions of dollars into internet-based companies. Many of these firms, however, possessed little more than a catchy domain name and a vague business plan, leading to their eventual collapse and a devastating market correction that vaporized fortunes overnight. The primary concern today is that history may be repeating itself, with AI playing the role that the internet did 2 decades ago. Companies across the tech landscape and beyond are committing billions of dollars to AI initiatives, often driven by a powerful fear of missing out rather than a clear and profitable use case. This frantic rush to invest can dangerously inflate the valuations of companies associated with AI, pushing their stock prices to levels that are disconnected from their underlying financial performance or realistic future earnings. Should the promised AI revolution take longer to materialize or fail to deliver on its grandest promises, these inflated valuations could collapse, triggering a painful market downturn. The current market environment exhibits several classic warning signs of a potential speculative bubble. There is widespread, almost euphoric excitement about the technology's potential coupled with massive and indiscriminate capital investment. Stock prices for AI-related companies have soared, often based more on optimistic future narratives than on present-day profits or revenues. While artificial intelligence is undeniably a powerful and transformative force, the prevailing fear is that the market's expectations have become detached from reality, setting the stage for a major disappointment. This has led to a palpable shift in investor sentiment, with many now proceeding with far greater caution. In this climate, investors are faced with the difficult task of separating genuine, sustainable innovation from purely speculative hype. The challenge is to identify the companies that are building real, long-term value with AI, and to avoid those that are simply riding a wave of market enthusiasm. The specter of the dot-com bust serves as a powerful cautionary tale, reminding everyone that even the most revolutionary technologies can be subject to cycles of boom and bust. The key for investors now is to remain disciplined and analytical, resisting the urge to get swept up in the frenzy, and risk getting caught if the AI bubble were to burst. The pervasive anxiety surrounding the immense investments in artificial intelligence is not confined to the technology sector. Its tremors are being felt across a diverse range of other industries. For instance, established companies that specialize in providing data, information, and analytics services have been particularly hard hit. Their stock prices have fallen sharply as investors grapple with the worry that new, more powerful generative AI tools could render their existing products and business models obsolete. The looming threat of AI disruption means that long-standing profitable enterprises are suddenly perceived as vulnerable, their futures clouded by technological uncertainty. A clear and specific example of this phenomenon is the case of RELX, a global provider of information-based analytics and decision tools for professional and business customers. The company saw a significant portion of its market value evaporate in the wake of heightened AI fears, even without any direct negative news about its own performance. This illustrates how the mere potential of next-generation AI can devalue established companies that are seen as susceptible to being outmaneuvered or replaced by more advanced automated systems. Investors are now reevaluating the long-term viability of countless businesses, scrutinizing their ability to adapt to or compete with the rapid advancements in artificial intelligence. Beyond the world of software and data, other foundational sectors of the economy are also navigating a complex and uncertain future, albeit for different reasons. The automotive and steel industries, for example, are contending with their own unique sets of challenges and opportunities driven by shifts in global supply chains, evolving consumer preferences, and the transition to a green economy. The overall market mood, which has been soured by the jitters in the tech sector, adds another layer of complexity and risk for these industries. A nervous market is less likely to fund ambitious capital projects or tolerate short-term setbacks, making it harder for these companies to navigate their own transformations. This chain reaction demonstrates the interconnected nature of the modern global economy. A major shock in one sector, especially one as influential as technology, inevitably sends ripples throughout the entire system. Companies in seemingly unrelated fields find themselves affected by shifts in investor sentiment and the reallocation of capital. The current focus on AI has forced businesses in every industry to consider their own position in this new technological landscape, asking themselves whether AI represents a threat, an opportunity, or both. The answers to these questions will likely shape the corporate winners and losers for years to come. Despite the alarming nosedive in Amazon's shares and the palpable anxiety that rippled through the technology sector, there were encouraging signs of resilience in the wider stock market. Major market indexes, including the S&P 500 in the United States and the FTSE 100 in the United Kingdom, managed to post gains during the same period. This divergence suggests that while investors were clearly spooked by the tech sector's colossal spending plans, their confidence in the underlying strength of the overall economy remained largely intact. The market appeared capable of containing the damage to a specific area rather than succumbing to a full-blown panic. This recovery in the broader market indicates a sophisticated and rational response from investors who were able to differentiate between the specific concerns about tech valuations and the general health of other industries. It appears that capital flowed out of certain overextended technology stocks and was reallocated into other, more stable sectors of the economy, such as consumer staples, healthcare, or industrial goods. This rebalancing act was crucial in preventing the tech-led sell-off from escalating into a widespread market crash, showcasing a degree of maturity and resilience within the global financial system that was perhaps absent in previous downturns. Another noteworthy sign of stabilization emerged from the volatile world of cryptocurrency. Bitcoin, the leading digital asset, which had recently experienced its own downward pressure and fallen to lower price levels, began to stage a rebound. This recovery suggests that some investors' appetite for risk was beginning to return, or at the very least, that the initial shock of the tech sell-off was beginning to subside. The concurrent bounce back in different corners of the market, from the most traditional stocks to the most speculative digital assets, offered a glimmer of hope that the worst of the immediate turmoil might be over. Ultimately, the market's performance painted a complex and nuanced picture. It was not a story of uniform collapse, but one of rotation and re-evaluation. While the technology sector faced a stern reality check, other parts of the market demonstrated their robustness. This selective sell-off allowed the financial system to let some air out of the most inflated parts of the market without causing a systemic crisis. The episode served as a reminder that the economy is not a monolith, and that strength in some areas can help offset weakness in others, providing a crucial buffer during times of uncertainty. Amid the turbulence on Wall Street, fresh data on U.S. consumer sentiment provided a sliver of good news, showing a modest overall improvement. However, a closer look at the numbers revealed a stark and widening divergence within the population, painting a picture of two very different economic realities. The uptick in confidence was driven almost exclusively by wealthier Americans. This affluent demographic has been the primary beneficiary of the strong performance in the stock market over the past year, and their swollen investment portfolios have directly translated into a more optimistic financial outlook and a greater willingness to spend on goods and services. For many other segments of the American population, the economic picture is far less rosy. While the wealthy feel increasingly secure, buoyed by their asset gains, a large number of middle and lower-income households continue to grapple with persistent economic pressures. The lingering effects of high inflation, which have eroded their purchasing power, combined with the burden of higher interest rates on mortgages, car loans, and credit card debt, have left them feeling cautious and financially stretched. This creates a deeply divided economic landscape, where one group's optimism is starkly contrasted with another's ongoing anxiety, complicating the outlook for overall economic growth. The data clearly highlights just how closely the confidence of wealthier consumers is tethered to the fortunes of the stock market. Their recent optimism is a direct reflection of the paper gains they have accumulated in their brokerage and retirement accounts. This strong correlation implies that their positive sentiment is built upon a somewhat fragile foundation. A more prolonged or severe downturn in the market, such as the one hinted at by the tech sell-off, could quickly reverse these feelings of security and lead to a sharp pullback in their spending, which has been a key driver of the economy. This economic divide presents a significant challenge for policymakers and businesses alike. An economy that is heavily reliant on the spending of a single asset-driven demographic is inherently less stable and more vulnerable to market shocks. While the current improvement in headline consumer sentiment is a welcome sign, its narrow base is a cause for concern. Achieving a more balanced and sustainable economic recovery will require conditions that boost the financial well-being of not just the wealthy, but all segments of the population, ensuring that prosperity is more broadly shared. In these turbulent times, characterized by rapid-fire market movements and a deluge of online speculation, the importance of reliable fact-based journalism becomes more critical than ever. The sudden and dramatic drop in Amazon's stock price is a perfect example of a complex event that can easily be misunderstood or sensationalized. To make sense of what is truly happening and why, the public needs access to trustworthy news sources that can cut through the noise, provide clear context, and explain the intricate connections between corporate strategy, investor psychology, and the broader economy. This is the fundamental mission of quality journalism: To fulfill this mission effectively, news organizations require resources. The article makes a point to emphasize that producing high-quality journalism is a costly endeavor that relies on the financial support of its readers. This support is what funds the reporters who investigate stories, the editors who ensure accuracy and clarity, and the fact-checkers who verify information in an age rife with misinformation. Without a sustainable business model, often built on reader contributions or subscriptions, it becomes increasingly difficult for news outlets to maintain their operations and continue the vital work of keeping the public thoroughly and accurately informed. The ultimate objective, as articulated in the broader discussion around this news, is to ensure that credible information remains accessible to everyone. By supporting independent journalism, readers are not just paying for a product, they are investing in a crucial pillar of a functional society. This support directly enables the creation of a reliable body of information that can serve as a powerful antidote to the spread of fake news, propaganda, and uninformed speculation. An informed public is better equipped to make sound decisions, whether about their personal finances, their careers, or the leaders they choose to elect. This role becomes especially vital during periods of market turmoil and economic uncertainty. When fear and greed drive market behavior and complex events unfold at a dizzying pace, the need for a calm, authoritative, and unbiased voice is paramount. Journalism at its best provides this voice, helping people to navigate the chaos with a clearer understanding of the facts. In doing so, it not only serves its readers but also contributes to a more stable and rational public discourse, which is essential for the health of both our financial markets and our democracy.